Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In this video, we're going to analyze Alphabet stock, or also known as Google, to see if it's a great business for long-term investing and to see if the stock is undervalued now. Alphabet is one of my favorite long-term investments. If you look at Alphabet's stock performance here, you can see it has outperformed the S&P 500 by a large margin in the past 5 years. Alphabet stock grew nearly 240%, while the S&P 500 grew almost 99% during this period. Obviously, past return does not guarantee future results, so I believe it's important to understand Alphabet's long-term business prospects, its biggest competitive advantage, its primary risk, and its fair intrinsic value per share first before investing in it. In this video, I will give you an in-depth analysis of Alphabet by covering these topics. What is Alphabet's business model? Is Alphabet a near monopoly? Alphabet's two long-term growth catalysts? Alphabet's two main risks to consider? What is Alphabet's fair intrinsic value per share? And will I buy Alphabet stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the best stocks I'm buying for the long term and download the latest intrinsic value calculators, so you know when a stock is currently overvalued, fairly valued, or undervalued. The link is in the video description. Take a look, let's start. So what is Alphabet's business model and how does Alphabet earn its revenues? Before investing in any stocks, I believe it is important to understand the business and its products and services first. Alphabet's primary products and services include Google Search Engine, YouTube, Chrome web browser, Gmail, Google Cloud Platform, Google Workspace apps, Android operating system, Google Play Store, Google Drive, Google Map, and Pixel smartphones. All these products and services make up Google or Alphabet's ecosystem. Alphabet also has other bets and new business initiatives including DeepMind, Verily, and Waymo. Alphabet's primary businesses are search and advertising. It earns revenues primarily from ads from Google Search Engine, YouTube, or third-party websites that have Google ads under Google's advertising network. In the recent Q2 2021 quarter, Google advertising contributed 81.52% of total revenues. Alphabet also earns revenues from the Android Play Store, Google Cloud Services, and other bets. If you look at this operating income by segment here, you can see Google Services, which is primarily Google advertising, earns all the operating income. Google Cloud and other bets are not profitable yet. In terms of profitability, Alphabet has a very profitable business model. For example, its operating margin was 31% in the recent Q2 2021 quarter. Its operating margin was 23% in 2020 and 21% in 2019. This is from Morningstar. If you look at these financials here, in the past 3 years, you can see Alphabet had very consistent revenue growth, operating income growth, operating cash flow growth, and free cash flow growth. These are very good trends because it shows Alphabet has a very strong business model with great economic modes. It has consistent revenue growth every year, even in 2020 when most businesses were impacted by the pandemic. Alphabet also has a strong balance sheet. For example, according to the recent Q2 2021 balance sheet here, it had 135.86 billion of cash equivalents. This is more than enough to pay off all the short-term and long-term debts. When the US interest rates start to increase and when the US Fed starts tapering its 120 billion monthly bond purchase program, it should not have a large impact on Alphabet's business because Alphabet does not have a large amount of debts compared with its cash equivalents on its balance sheet. Now, here is another important question you may ask. Is Alphabet a near monopoly business? In my opinion, Alphabet has several businesses that are near monopolies, including Google Search Engine, YouTube, Android OS, and Chrome. Personally, I believe Alphabet has large economic moats and many competitive advantages that can protect its businesses from most competitors. For example, Google is the largest and most popular search engine in the world, especially in North America. According to StatsCounter, the Google search engine has a global market share of 92%. The next closest competitor is Microsoft Bing, with a much smaller global market share of 2.66%. But if we consider all other search engines, including e-commerce and video search engines, the second largest search engine is actually YouTube. not Microsoft Bing. YouTube is essentially a search engine for videos. For example, according to this website here, YouTube has 2.29 billion users, which is only behind Facebook's 2.85 billion users at the time of making this video. Also, the Google Chrome web browser has the largest market share of 65% at the time of making this video. If you're an advertiser, you want to invest most of your advertising budget in Google's advertising network because most users use Google search engine, YouTube, and Chrome web browser to look for things they're interested in. Google also owns the Android operating system that has the largest market share in the world. As of now, the smartphone market is a duopoly between Apple iOS and Android OS. At the time of making this video, Android OS has a global market share of 72.45%, while Apple iOS has a global market share of 26.74%. Android OS has the largest mobile market share. One of the biggest reasons is that Android is open source and is free to all users and hardware manufacturers to use and distribute. Alphabet doesn't earn revenues directly from the Android OS, but instead it earns revenues from the Google Play Store and ads placed in Google search engine, YouTube, Google Chrome, third-party websites, and apps on our Android smartphones. I believe Alphabet's first primary long-term growth catalyst is its increasing advertising revenues from advertisers around the world that rely on Google's search engine, YouTube, and Google's advertising network partners. This is from eMarketer. eMarketer forecasts that digital ad spending worldwide will continue to grow steadily between now and 2024. Digital ad spending means ad spending on internet services such as search engines, social media, web browsers, websites, online videos, and apps. Most consumers are spending much more time on their smartphones and on their computers instead of TV. This is why advertisers are investing much more in digital ads instead of traditional non-digital ads now. For example, the blue line here represents digital ad spending as a percentage of total media ad spending. You can see digital ad spending is expected to be 60.9% of total media ad spending in 2021. This trend is expected to increase going forward because advertisers are spending more money on digital ads now than non-digital ads. Here's the important part you want to know. The digital advertising market is a duopoly between Google and Facebook. Most advertisers spend most of their digital ad budgets on Google and Facebook because they have the most active users each month. Amazon is the third largest player in the digital advertising market in the US. This is from eMarketer. You can see Google and Facebook have the largest market shares in total digital ad spending. We have to exclude Alibaba and Tencent Holdings here because they mainly operate in China. This means Amazon is the third largest player in the digital advertising market worldwide, excluding China. If you're an advertiser, you will want to invest most of your ad budget in the largest platforms that have the most users and that can give you the most return on ad spend. I believe the overall online advertising market will continue to increase because advertisers are spending more money on digital ads instead of non-digital ads. This is why I believe Google's advertising revenues will continue to grow for many years. As of now, Alphabet owns the two largest search engines in the world, Google search engine and YouTube. Alphabet's Android OS has more than 2.5 billion active users in the world, so it makes sense for most advertisers to invest a large portion of their ad budgets in Google's advertising network. I believe Alphabet's second long-term growth catalyst is its Google Cloud business. I believe the cloud computing market, especially in infrastructure as a service and platform as a service, will continue to grow for many years because of the increasing adoption of cloud computing by many organizations around the world. The pandemic that started in 2020 actually caused many organizations and large enterprises around the world to accelerate their digital transformations and their adoption of cloud computing. During the pandemic, they realized their businesses are not as resilient and flexible as they initially thought. For example, many traditional businesses did not have the technologies to let their employees work from home and work at offices at the same time. Also, many large organizations and enterprises are investing a large part of their IT spending in cloud services now. For example, instead of building their own data centers in-house that costs a lot of money to build and maintain, many large businesses choose to use data centers and infrastructure cloud services provided by the largest three public cloud providers, Amazon, Microsoft, and Google. According to this article, the current public cloud market in infrastructure as a service, IaaS, and platform as a service, PaaS, is dominated by Amazon AWS, Microsoft Azure, and Google Cloud. Alibaba is the fourth largest cloud provider. According to Canalys, the top 3 cloud service providers accounted for 61% of total cloud spend in Q2 2021. During this period, Amazon AWS had a market share of 31%, Microsoft Azure had 22%, and Google Cloud had 8%. If you look at this here, you can see the worldwide cloud infrastructure services spend have been growing very consistently every quarter in the past 3 years. According to Gartner research article, it said, as a result, global cloud adoption will continue to expand rapidly. Gartner forecasts end-user spending on public cloud services to reach $396 billion in 2021 and grow 21.7% to reach $482 billion in 2022. Additionally, by 2026, Gartner predicts public cloud spending will exceed 45% of all enterprise IT spending, up from less than 17% in 2021. If you look at this table here, you can see infrastructure as a service, IaaS, platform as a service, PaaS, and software as a service, SaaS, are expected to have the largest cloud spend in 2021 and 2022. This is a good sign for Alphabet because Google Cloud is one of the 3 largest cloud providers in the world. Amazon AWS and Microsoft Azure will also benefit from the increasing adoption of cloud computing around the world. Personally, I believe Google Cloud will eventually become a very profitable business for Alphabet. This is similar to Amazon AWS contributing the most profit for Amazon, and similar to Microsoft's intelligent cloud business contributing the most profit for Microsoft. So what are the primary risks we should consider? I believe Alphabet's first primary risk is antitrust litigation. According to this NPR article, Google is appealing a $5 billion antitrust fine in the EU court. The EU's antitrust regulator has fined Google multiple times for antitrust behaviors between 2017 and 2019. The antitrust penalties have totaled more than $8 billion. The antitrust fines mainly focus on Google's dominant positions in its search engine, digital advertising business, Android OS, and Chrome web browser. If you look at Alphabet's most recent quarterly report and annual report, you will see all the ongoing antitrust investigations here that show the European Commission has fined Alphabet multiple times in the past for antitrust behaviors. Alphabet has appealed to each of these fines. This is just my opinion. Even if Alphabet pays all these antitrust fines that are more than $8 billion, it will not affect its business much because the company generates a lot of free cash flow every quarter. For example, it had a free cash flow of $16.4 billion in the recent Q2 2021 quarter. But I do believe Alphabet will likely face more antitrust litigations and possibly more fines going forward. I believe Alphabet's second primary risk is the US increasing interest rates that will impact all stock valuations in the US. Stocks generally do very well when interest rates are low, but when interest rates start to increase much faster, stocks generally do not perform as well. At the time of making this video, the US PCE inflation rate is at 4.3%. This is much higher than the US Fed's average 2% target inflation rate. If the US inflation rate continues to be much higher than the 2% target inflation rate for a long period, the US Fed will start tapering its $120 billion monthly bond purchase program or its quantitative easing program much earlier. If the current high US inflation rate is not temporary, then the US Fed will also start increasing its interest rate faster after the US Fed's tapering ends. When interest rates increase, all stock valuations will generally decrease. One reason is that borrowing costs for businesses will be higher when interest rates increase. Let's talk about Alphabet's intrinsic value per share. First, I define Alphabet's intrinsic value as its future free cash flows discounted to the present day. I always use this intrinsic value calculator to estimate a stock's fair interest value. Here are the key assumptions. The discount rate is 8%. This is slightly higher than the 7.3% cost of equity rate calculated by Thinkbox.com. If you want to be more conservative, you can use a higher discount rate of 10% or more here. Alphabet's trailing 12 months of free cash flow is $58.54 billion. Based on the long-term growth catalysts I talked about earlier, I believe Alphabet's free cash flow will grow at a compound annual growth rate CAGR between 15% and 25% over the next 5 years. If you want to be more conservative, you can use a lower compound annual growth rate here. To calculate the terminal value here, we are using both the perpetual growth model and the exit multiple model. Then we take the average of both models to calculate the terminal value at the end of year 5 here. Let's go over these 3 case scenarios here: the worst case, the normal case, and the best case scenarios. Under the worst case scenario, we are using a compound annual growth rate CAGR of 15%. If we forecast Alphabet's free cash flow to the next 5 years and discount the free cash flow to the present day, Alphabet's intrinsic value should be around 1.8 trillion for the entire company, or $2,706 per share. I'm giving this scenario a probability of 25% here. Under the normal case scenario, we're using a compound annual growth rate CAGR of 20%. If we forecast Alphabet's free cash flow to the next 5 years and discount the free cash flow to the present day, Alphabet's intrinsic value should be around 2.2 trillion for the entire company, or $3,298 per share. I'm giving this scenario a probability of 50% here. Under the best case scenario, we're using a compound annual growth rate CAGR of 25%. If we forecast Alphabet's free cash flow to the next 5 years and discount the free cash flow to the present day, Alphabet's intrinsic value should be around 2.66 trillion for the entire company, or $3,993 per share. I'm giving this scenario a probability of 25% here. If we add all these numbers here, Alphabet's fair intrinsic value should be around $3,323.73 per share at the time of making this video. This means Alphabet stock, in my opinion, is likely undervalued at the time of making this video. Just to compare, Morningstar estimated Alphabet's intrinsic value to be around $3,200 per share. So will I buy Alphabet stock? Yes, I will continue to buy more Alphabet shares for the long term. I already have Alphabet shares in my portfolio. I invested in Alphabet or Google many years ago because I like its near monopoly businesses, including the Google search engine, YouTube, Android OS, and Google Chrome. I also like Google Cloud. I believe it will eventually become a profitable business. Personally, I believe Alphabet's fair interest value is around $3,323.73 per share based on the estimates I talked about earlier. This means Alphabet stock, in my opinion, is likely undervalued at the time of making this video. Now, all these estimates are only my opinion and my analysis based on my research. They are not financial advice. As always, make sure you always do your research and do your extra due diligence first. If you like this video, hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the stocks I'm buying for the long term and download the latest intrinsic value calculators, so you will know when a stock is currently overvalued, fairly valued, or undervalued. The link is in the video description. Thank you for watching this video. This is Victor from the Intelligent Investor channel, and I will see you in the next video.